With soaring energy prices, we have been concerned about inflation. U.S. consumer prices coming in largely as expected, but of course, we got inflation still sitting above the Fed's target. Gas price concerns. Are interest rate cuts still on the table for 2026? Joining us now to discuss is Alex Gorewicz, VP and Director for Active Fixed Income Portfolio Management with TD Asset Management. We'll clear the AR to start with. These are backward-looking numbers now for CPI. Does it matter as much what we got today or the situation that we're in and moving through?
Certainly the situation that we're in and moving through in the Middle East matters a lot more for interest rates, for what you think central banks are going to do. But today's CPI number came in line with expectations, call it 0.2 to 0.3% for headline CPI or core CPI, that's excluding food and energy. And then year on year, about 2.4, 2.5%. Because those numbers came in line with expectations, underlying details were all pointing to pretty benign inflation on a backward-looking basis. Bond market didn't react to that print.
Didn't react to the print. So let's talk about the situation we're in right now. It is fluid. We have seen, just in the past couple of days, I know you've been on calls with your colleagues. Hussein Aladina was in our studio to start the week. Oil rocketing to almost $120, falling below 80 right now, approaching 90. What do we do with those kind of fluctuations where we're trying to figure out where we're headed in terms of the cost of living?
So to me, the fluctuations in energy prices in capital markets worry me a lot less than every passing day hearing about more disruptions. And Hussein and his commodity team are instrumental to us getting that detailed analysis on what is happening day over day, because it is important to remember that it's not just about energy. There are a lot of other commodities that flow through that region. And if I take more even of we'll call it a macro view, beyond just commodities, any type of supply-related disruption, as we've seen, not that long ago, only a few years ago, could result in more sustained inflation globally, and then it will matter from country to country.
What is the Fed supposed to do with all of this? The markets are already sort of pushing out the idea that you're going to get a cut. Maybe it's in September. Some participants even throwing it out there, maybe not at all. How do we start thinking about where the Fed could move?
So if we look at right now, and again, this is not related to the CPI print, there was no repricing of Fed expectations on that CPI print. If we look at the broader issue with Iran, since the start of the war, if I could even call it that, we've seen every central bank get repriced hawkishly. In other words, if there were rate cuts, now there are rate hikes priced in for 2026. The Fed is the only one, especially among developed markets, that is still pricing rate cuts, but just one less than we were pricing at the end of February. So right now, I think the bond market has 1.5 rate cuts to the end of the year, whereas before it was closer to 2.5 and 3.
The thing about the Fed as well is that we're going to get a new chair, right? This is inevitable. It has been someone, presumably the U.S. president has picked, thinking that they would be a little more aligned with the White House's vision of where rates should be.
Yep.
But where does that start to come to play? Is this a conflict at all, or do you figure Mr. Warsh will go with the data just like any central banker would?
I think the immediate reaction when it was announced that he would be the nominee, the immediate reaction from the bond market was that we'd have more of we'll call it a reasoned approach to monetary policy, in that there must still be economic justification for the decisions the Fed will be making. And I think investors are probably still expecting that. The challenge now is, and we haven't heard Warsh speak, so this is, we're looking back a little bit in terms of
looking at his history to try to figure out who he's going to be in the big chair.
Correct. So we need to keep that in mind too. But if we look back at a lot of his sort of reasoning or argumentation, I think he relies a lot on the fact that the AI productivity gain will more than offset any kind of inflationary impact. But this was pre-Iran war. Now, with every passing day, like I mentioned, as we have to start worrying about supply disruptions globally and across sectors, not just commodity specific. Now we need to consider how the potential for more sustained inflation will be weighed in his mind against sort of the AI productivity boom. Too early to tell. And here I would say it's hard to paint every single country with one brushstroke. So what do I mean? If you're an energy insecure country, basically you import the vast majority of your energy needs, or you have an energy trade deficit, like say Europe and certainly Asia, you've seen a much more pronounced hawkish repricing of those central banks. In other words, there is expected to be more sustained inflation beyond just a one or, call it a couple of quarters of energy price shocks. In North America, US included, we're not net energy importers, quite the opposite, and especially Canada, a significant exporter. There, the situation is a little bit more nuanced. The bond market is saying, yeah, we're going to reprice Bank of Canada and Fed a little bit more hawkish, but not nearly as much as other countries that are going to be much more impacted by this energy shock.
When we have this much uncertainty and this much risk, I'm taking a look at the U.S. 10-year. It's moved higher. The yield's higher. It's a little above 4.2% right now. But is the bond market right now behaving in a way you think it would behave with this much risk on the table?
Certainly not in North America. And the reason I say this is North America, Canada and US have seen inflation expectations, which is one of the key components of how interest rates move. They've seen those inflation expectations quite anchored, especially at the long end of the curve. It speaks to investors expecting this not to be a durable inflation shock. That's not what other markets are saying, in particular the ones that have large energy trade deficits. But someone's going to be right here, right? And the question is, who? So when we look in North America, a large part of the repricing has not come through inflation expectations. It's come through real yields. In other words, there could be some net benefits longer term for our economies. And which is probably why the rise in yields has been a lot more contained than in other markets. But again, every passing day, I worry that that shoe's going to drop on inflation here at home too.
What does a fixed income investor do with all that information? What can we do at this point?
Yeah, so the reality is to try to create some sense of calm within what's happening in bond land is really difficult because a lot of people draw parallels to Russia's invasion of Ukraine in 2022, the spike in energy prices at that time. I think it's important for bond investors to remember one critical difference between now and then. Interest rates are higher. When interest rates are higher, the coupons that you're getting, the cash flows you're generating from your bond investments are substantially higher. Those provide a cushion for this kind of volatility that we're seeing. That's extremely important. The second thing, and that is probably less focused on, and it's less about bond investments and it's more about, we'll call it asset allocation, how to think about bonds relative to equities, is how the volatility in bond land is behaving today versus equities, and compare that to 2022. In 2022, with Russia's invasion of Ukraine, both equity and bond volatility went higher, but bond volatility went a lot higher. It was very clear to markets that was a bigger deal for bonds than it was for stocks, although both of them had very bad years. That's not the case this time around. This time around, you're seeing a small increase in bond market volatility, especially in North America, but a much more pronounced one in equities. To me, this is saying that the longer this goes on, the more the shoe is likely to drop in risk assets than bond land. And again, that could be a function of just higher income that is providing more of a cushion.